Hi everyone, this is Ted Bauman, editor of the Bauman Letter with your Friday Bauman Daily video. This week I'm going to talk about the future, and I don't mean the short-term future of the stock market, which is something I've addressed quite significantly in the last couple of weeks, but I want to talk about what's going to happen in the long term and how the virus pandemic is going to change the economy and the world we live in. Now, I know it seems like a pretty big picture issue, but in my view, that's what investors should always be looking for. We should always be looking for clues to how the world is going to unfold in the future. Now, on that score, there are a lot of people who focus narrowly on technology and predict that technology is going to change everything and make the world a different and better place, and that if investors can get on that bandwagon, they'll do well. But the reality is that technology is always adopted in the context of a particular way of organizing society, the way people relate to each other, the way governments operate, and so on. So it's not a neutral thing. So I tend to focus on that bigger picture. I tend to focus on what is likely to happen at the political level, at the social level, and how that's going to affect stocks as well as the future of the economy. Freudian slip there. Now, I do that because as an economic historian, that is the way I was trained to look at the world, and I found it to be incredibly useful over the years to be able to understand the trends, not just in economics, not just in markets, but in the bigger picture, the world as history unfolds. So today, I want to share with you 7 predictions for the shape of the economy, the market, and the world after the COVID virus is resolved one way or another. Now, you may think it's fairly bold of me to make these kind of predictions, but I think it's important, even at these early stages, to try to start thinking about how things are likely to be. The reason is that big events like this in history, things like global pandemics, tend to have tremendous long-term impacts. They change the way people think about things, the way people behave, the way people make decisions. And I think this is going to be particularly the case in this virus, which is really the first major challenge to the global order since the end of the Cold War. So, with that as a background, here are my 7 predictions. The first one, at a very specific level, is that companies are going to change the way they operate, and that's going to have important ripple effects. For example, 49% of companies in a recent survey said that they're planning to make remote work an option for the near future. That will obviously have a significant impact not just on those companies, but on those employees and also local economies where those employees live. For example, if people are staying home and working, you may see an upsurge in demand for local goods and services like food delivery restaurants at times where they're not currently demanded. That's just an example of a small change. But 40% of CTOs from the same companies, the financial and technical directors, say that they're planning to move in the direction of more automation. Now, that means that at the same time that we see a change in the way people are working, maybe working from home, we're also going to see some job losses due to automation. I wrote in a recent Bauman Daily that that is one of the most typical outcomes of any kind of a recession, that companies try to avoid having to hire back low-wage labor, low-paid labor, and try to replace them with machines. And this is going to be the case here. Now, 25% of large companies in the United States say that they're going to reduce their real estate footprint. In other words, they're going to stop putting their employees all together in big buildings, either downtown or in big office parks outside of cities, and make them available, and make some of their people work off-site at home. Now, that in turn will have impacts on the real estate market. Finally, 80% of them say that they're going to update and increase the rate of adoption of technology-based relationships with their clients. In other words, they're going to be moving more sales online. They're going to be doing everything they can really to try to turn their operations into distance operations. And that's something that is logical given the impact of the virus. Now, in this context, here's my second prediction. Some companies are going to struggle to adapt. Now, it's no secret that physical retail chains like Neiman Marcus and Macy's, etc., are in serious trouble. They've been struggling ever since the beginning of the online retail revolution, if you like, but this virus is accelerating that. And the fact that many of these companies like Neiman Marcus were bought out by private equity firms that have loaded them up with debt in order to pay themselves huge special distributions of dividends, means that these companies have no financial legs to stand on. So I predict that we're going to see the loss of a number of major retail chains. And of course, that will have a big impact also on the real estate sector as well, particularly malls. Same thing will happen to chain restaurants, movie theaters, and other places where social distancing is difficult. Even without the virus, which most experts say could take years to work its way through the global population, people, I believe, are going to be less comfortable with the idea of being crowded into physical spaces. Already, for example, we've seen one major movie theater chain say that they will no longer release a major production house's videos because that production house says that they are no longer going to premiere them in theaters. They're going to do it online. That's an example of the kind of change we're going to see. Thirdly, I think under that heading of companies that struggle to adapt, what's going to happen to the small businesses? Small businesses are going to struggle to reopen, and when they do, they're going to have a new level of risk that they never had to deal with before. What if there's another virus outbreak? That'll make lenders very, very leery of lending money to small restaurants, bars, and other small businesses. So we could see the small business sector lose a lot of dynamism. Now, the third major change is that global supply chains are going to contract, and we're going to see a pullback from the hyper-globalization that we've seen since roughly the beginning of the 1990s. Now, one reason is that the virus has exposed our vulnerability to imports from particularly China for things that are absolutely essential, like medicines, chemicals, personal protective equipment. All of those things that we can no longer produce for ourselves because of decisions made really by private companies seeking to maximize profit. I think that governments are going to override that, and companies themselves are going to decide to contract their global supply chains to try to protect themselves. So the combination of government and private sector really is going to lead to a lot of onshoring of production that is currently offshored. That could also lead to a focus on mergers, political focus on mergers that reduce competition. We saw a case earlier this year where a company that was promising to produce low-cost ventilators for a U.S. government contract was bought by a larger company. The Federal Trade Commission didn't object, and as a result, that company stopped making ventilators. So the larger company decided it wasn't profitable, so they no longer do it. So what I expect to see is a lot of attention paid to these kinds of potential mergers that could reduce the supply of essential goods. Now, one other thing that could happen as a result of the decline in offshoring is the fact that if we have a lot of economic activity returning to the United States in the form of production of physical goods and services rather than just services, I think that we could see a resurgence of inflation. And that's because inflation happens when we run out of productive capacity. That hasn't happened for years, largely because production has been leaving the United States going to China. If that reverses, we could get into a situation where all the available labor is used up. Great for labor, not so great for inflation. So that's a potential knock-on effect of the contraction of global supply chains. The fourth potential outcome that I see is that the economy will become more concentrated. Now, we've already seen that the stocks of the very largest companies, particularly in the technological sectors, have been the leaders in the mini pullback that we've experienced during the course of this month. Now, that's going to be the case also with companies that have massive footprints, big economic moats around them, and deep pockets, and that includes some of the big consumer goods conglomerates. That will mean that smaller companies are going to struggle to make headway to get into the market against big firms that, in a sense, have survived this big collapse. The second thing is that I expect to see in that space that private equity firms will gobble up smaller firms that are financially distressed. We've already seen that happening. So again, that will lead to a contraction of the number of companies operating in any particular sector. We will also, I think, tend to see a situation where bond markets and corporate lenders are reluctant to lend money to companies that are just getting started. They'll be concerned about companies that operate at a loss because what happens if there's another event like this and companies don't have money to survive? So I think all in all, we're going to see a contraction of the number of firms operating in any given market, which leads to the possibility of monopoly pricing, reduced economic dynamism, the potential for wage suppression for companies that are single employers in some areas. And of course, finally, I think we'll see it very difficult for so-called unicorns, companies that are developing new products and lead with losses, like the Ubers and the Lyfts and the WeWorks and companies like that. They were already getting hit hard in 2019, but I predict that it's going to be extremely difficult for them to raise private venture capital money unless they have a sure thing. Particularly unicorns that are focused on the physical world, like the Ubers and Lyfts and Pelotons, etc. They will have to prove that they have viable business models that can produce actual income in short order. Years and years of losses are not going to be tolerated, I think. Fifth, and this is in some ways the most important one of all, we will see a deleveraging of the economy. One of the reasons why this crisis has been so severe is that the economy, not just the public sector, but especially the private sector, was deeply in debt. We've seen an explosion of corporate debt over the last decade for reasons that I've spoken about in other videos and articles. And really the main reason for that is because with the stock market, or rather with bond markets delivering such low yields with interest rates so low, people have looked for yield elsewhere. And one place to do that is in the junk bond market. The companies that are financially distressed, borrowing at less than BBB ratings. Now, what happens then is that when many people are looking to lend, it means that it's a borrower's market. And so interest rates have fallen in junk bond markets. I think that's all going to reverse. I think that now that the Fed has had to step in essentially to rescue the entire corporate debt market in this instance, people are going to be very hesitant about lending money back into a market, especially if, as I predict, the Fed says, look, we don't want to have to do this again. Please sort yourselves out. The next time this happens, we won't rescue you. Now, that could lead to a contraction of investment as firms find it more difficult to raise money in debt markets. The same thing could happen to individual households. So when you have a deleveraging, it means that people are paying down existing debt and are reluctant to borrow new debt. As a result, they're spending less on new goods and services, which tends to act as a drag on the economy. So as a result, essentially, we could be looking at a situation of ongoing stagnation in the economy as people try to pay down debt. Now, this deleveraging that I speak about is something that many economists have been predicting for years is something that the global economy desperately needs. The global economy is massively over-indebted. There is far too much forward anticipation of earnings. Far too much economic activity in the future is already spoken for in the form of debt repayments. So I predict that we're going to see a pretty serious deleveraging effort. Even if the economy is in good shape, people are going to want to cut back on lending and borrowing. And that may also be as a result of public sector initiatives to reduce the amount of debt that the economy accumulates. If that happens, it simply means that the economy can't grow as fast as it would otherwise because people are paying down debt rather than producing more for future consumption. Now, that leads to the Fed, and here's my sixth prediction. I believe that the Fed is going to change the way that markets operate. I think essentially what's going to happen is that people are going to learn that fighting the Fed sometimes makes sense. Right now, the stock market is in really a bubble scenario given the underlying earnings potential, given the fact that we're looking at perhaps 20 to 30% declines in GDP in the second quarter, and yet stock prices are still going up. Now, people say that you can't fight the Fed, that the Fed is pumping liquidity, so people are going to buy stocks. But stocks, when you buy them for that reason, are just like loans, in the sense that you're betting on future economic production. You're betting when you buy a stock in a company at a PE ratio of 30 or 40 or 50, that company's earnings are eventually going to catch up. Well, the reality is that I think people are going to figure out towards the end of this crisis and going into next year that just because they can get money to buy stocks and push up prices doesn't mean they should. And I believe that people are going to become more skeptical about Fed liquidity being the reason to buy stocks. They're going to start looking at the other side of the equation, which is earnings and the real economy, something that I focus on first and foremost. I'm not saying that people are necessarily going to give up on the idea that the Fed's liquidity and low interest rates are going to prop up the market. But the reality is that they can't carry on the way they are. We're already at zero. We can't go below that. If we do, we're in seriously uncharted territory. How much more debt can the Fed buy from markets? How much more liquidity can it put in? So eventually the Fed is going to have to reverse what it's doing, and that is going to lead, in addition to, I believe, a decline in the overall level of stocks, it's also going to lead to a rise in interest rates. If the Fed is reluctant to buy bonds, corporate, etc., that means that yields are going to have to go up because people are going to be bidding for those bonds, and the sellers of those bonds are going to be desperate to sell them to raise cash. As a result, I believe that we will see interest rates rise even in a situation of economic stagnation as a result of the deleveraging that I spoke about earlier. Now, again, this is not just theoretical. This is tracing out the logical outcomes of where we are. Now, finally, number 7, I think we're going to see big political changes. And this is where I think the perspective of the long arc of history is the one that's so useful. I think government at all levels is going to realize that it's not feasible anymore to have a very hands-off, laissez-faire approach. They're going to do things like try to force companies to bring production back on shore, to try to locally source goods and services, as I mentioned earlier. But I think they're also going to face far greater public scrutiny as to whether governments are actually prepared for these kinds of outcomes. The United States government, for example, was caught very flat-footed in this thing. We know that we didn't have the equipment or capacity or even the bureaucratic wherewithal to roll out a response that would have kept this virus under control in the way that other countries have done it, like South Korea, like New Zealand, Australia, etc. Countries can do this when they are properly, adequately supplied with decent, capacitated government. We don't have one in the United States at this point. Now, in order for that to happen, people are going to demand that the government beef up its capacity, which means that they're going to need to raise taxes, quite frankly. Right now, the government was running a massive deficit, even in a booming, so-called booming economy, because taxes were simply too low relative to the level of expenditure. Either we're going to have to cut our expenditure on things like the military and other big chunks of expenditure, or we're going to have to cut entitlements like Social Security and whatnot, the very things that people are demanding more and more of right now because of the insecurity that they face. Or taxes are going to have to go up on individuals. And I believe that that's probably what's going to happen. And I don't think it's a political choice of Republican or Democrat. I just think that the logic of the situation dictates that if we expect more from government, then government's going to need money to pay for it. And if that money cannot be cut from other places like retirement and medical care and things like that, then it's going to have to come from taxes, just like it does in many countries elsewhere in the world that have high tax rates but very high levels of government services. Now, part of the reason I predict that this is going to happen is because this virus has exposed some serious fault lines in the US economy. We've seen the difference between people who can work digitally and people who can't. We've seen people who have access to health insurance and people who don't, how big a difference that makes. We've seen the tremendous impact of precarious informal employment on individuals, people who really don't have any employment security and are regarded as contractors like Uber and Lyft drivers and so on. Now, eventually those people are going to realize that they've really received the short end of the stick in the last decade, and they are going to demand change. We already see an announcement of a May Day strike for the first time that I can remember in this country amongst just such people, like in Amazon warehouses and so on. Eventually that has got to filter through to political movements, and eventually that will lead to pressure on the federal government, on state governments, to take more responsibility for looking after society as a whole. And I think that will be accompanied by a backlash against, quite frankly, wealth. I believe that the ordinary person is going to see some of the abuses in this bailout, and they're going to conclude that the close relationship between very, very wealthy individuals and companies in the financial sector has led to policy responses that favor them over ordinary people. And on the other side of this crisis, ordinary people are going to demand a change. It may not happen all at once, but it's going to happen eventually. And if it doesn't, we will continue to be extremely vulnerable to these kinds of changes. So there you are, 7 predictions. In future videos and articles, I'll try to flesh some of these out and talk about implications for individual stocks. But I think it's a pretty good roadmap to what we're likely to see. Whatever happens, we're not going to return to the normal that we had before. Things are going to change, and it's best to start preparing for them now. This is Ted Bauman, editor of the Bauman Daily. Now remember, if you want to become a subscriber to the Bauman letter, up here, there's a little link you can click that takes you right to it. So please do that. Also, if you want to subscribe to my YouTube channel, you'll see a button down below that you can click to subscribe to it. So either subscribe to the Bauman letter, subscribe to the YouTube channel, or do both. I'd very much appreciate it. Ted Bauman signing off. I'll speak to you again next week.